Good afternoon. The time is 2:22 p.m. Date 5/29/2014. What do we have? We have the S&P 500 closing at record highs. We're going to go over some of the put options that have been purchased at record high volumes. In the last week, we pretty much have gone parabolic up, making higher highs throughout the session to 1920 on this S&P. Now, when we're covering a July 1900 put, we can clearly see that these put options were up here at $60. These are the ones that we originally had made $20,000 on. And since then, from $50 down to $24.75, this is a monthly expiration for July. So what we're going to show in here is what it looks like as far as the volume goes on this particular contract. The volume today was 13,000 contracts traded. Some of these guys are buying big volume. 13,000 of them traded. There was also, this was just the end of the day that I wanted to show at 15:45. But there were 13,000 traded. Some of them had 2,000 blocks of this contract. So one of the things that we're going to show is that when something has 13,000 contracts traded, which is right here, 13,103. Now, down here, we already had, prior to that, the open interest for that contract for July was only 7,500 contracts. We have traded 2 times the amount on this particular contract. So the volume was 2 times the open interest. And yes, these 500 blocks, there was some other blocks that were much bigger. As we feature the same $1,900 put going out to an August regular monthly contract. One of the things I'm going to say here is that the prior open interest on this trade, which is right here on August, where I'll pull this up a little bit, you can currently see that the open interest was 6,500 of these put options on the S&P, and today's volume was 9,813 contracts. Not to mention that there was record buying in other strike prices. We had an 1875 put, 9,000 contracts traded. We also can go to the 1850, and these are all the calendar month of August. There was 9,200 traded. Today there was exactly 7,500 open interest that was traded and whatnot, and the bigger one on an intraday volume, of course, was at 1875. And then one that we're featuring now is the August put contract. So the put contract that I have behind here is that August 14th regular. So once again, I have the chart pulled up for, as you can see, the monthly August. These contracts have almost been cut in half. There wasn't a lot of volume going into this today, but people, once again, are getting extremely high volume that this S&P is going to go down. Now, for the bull side, I'm showing an 1870 call that expires monthly January. And when these contracts are down here at $26, they've gone parabolically up. But then let us not forget, on the call side, they went parabolically down. That was inflated. This is inflated. There's going to be a change. We can clearly see that the last time they were inflated here, they got from $46 right down here to $25. Now, that is the call side. That's very exuberant. Now, let it be known that that's the 1870 call for January monthly expiration. Another one that we're going to show is the 1880 put, which is for the month of January. And not only that, we can clearly see that that open interest was already 37,000 contracts. And some of these days, like I can give an example right here, that there were extremely high volume days on 5/21. There was 20,000 contracts purchased then. On 5/19, the strike price was at exactly the 1850, which had a very high volume trade. Look at them now on the 1880 put for January. This is where the money is going to be made. They have marked these things down totally as we go through these put options on that put side. Now, one of the things that we're going to show is that 1850 put right here has been marked down, and this is a monthly January. And there was record buys in this today on the 1850. Prior to this, there were big bets on this contract. One day, there was a single transaction of 13,000 contracts that a trader had purchased. And ever since that purchase, we have gone straight down. And today, there was another 7,000 purchased down here at the bottom on that 1850 January monthly. Big bets are betting that this S&P is going to go down. And one of the things that I'm going to show over here is where that 1890 call. This is a call. This is at 1890. You've gone parabolically up. And over here, when they get inflated, we went parabolically down. And now we had bounces. This is the move. The bull is going to get a reversal. That 1890 doesn't have much further to go. Just as you can see over here on that inflated area. These things got marked down to down near $8. And right now they're right back up here at 36.75. And what is that one? 1890 call. So you know, MMT. And then check this out. The 1875 call for July 19th. Now, these aren't the Januaries. Look at that call is coming down, just like it did over here. And that means that the other side of this trade is going to pay money. One thing about options, index options or equity options, they always have the same outcome. It really doesn't matter. But I am telling you that these contracts that were at $30 are now $57. And I was telling people when they were inflated here that they were going to come down, and they did. But then they bounced, and this is how they trade. So right now, the put side is going to go higher on that S&P. Let it be known right now that that is the 1875 call side. One of the things is also here is an August one that we've been monitoring. Some of these are up here at $70 on the call side. They're coming down heavy. Once again, back to the July 14th. This is not August. This is July. And we're going to just feature again what an 1810 call looks like. It is trading right now at $112, and that is a July. And there isn't much data on it. The call side up here at $101, that's that 1810 call for July. The 1820 call, which is totally inflated, they're going to come down, is what we're telling you. I've already featured the 1850 call, but maybe I didn't. But here it is right now. This is that $1,850 call for the month of what? The calendar July month. And here's what happens. Here's what happens when they get inflated. They come straight down. They come straight down. That's going straight down. That means that the other side of this trade right here, short term, is the best place to put the money, because this particular 1850 put is down here at $3.75. Let it be known that there was a time when these were up here at around $63 per contract. They have taken all the premium out of them, as I'm showing you here. So let's move on and make sure. we were dealing with a lot of traders around the world here on that last conversation from that one guy. I was just picking up the dialogue so you could hear it because that's the kind of frustration that when these things get imbalanced and they go extremely high, psychologically it starts working on the other people. But once again, I'm just going to say that the July contracts, and I would also like to point out once again that things are mathematically, totally mathematically out of control, meaning that the upside of any good news is in this market, and any bad news, we're going down. And once again, that's going to be that summer volatility. Let us not forget that summer is only a month away in June. And so, therefore, when you hear other people that are talking about the S&P, or they're trading the contracts in the futures market, they're doing all of that. So basically, I'm just going to show you again that when they were buying 500, 1,000, 1,500 contracts, this is super big money. This guy made a purchase at $25. Once again, that's the $1,900 put. And once again, that was 750 contracts. That is a lot of money. And once again, this thing has been totally marked down. The discount is there. We own 11 of them ourselves. The most important thing, though, for people to know is that one of the things that we felt was very compelling was buying that 1920 strike price today. And like I said earlier, that was our purchase. And once again, you can just see where some of this money is going. I mean, there was 7,159 contracts traded at the 1870 puts. This was just the last little bit of volume that came in. But these are a lot. This volume, this is big. To buy an 1870, think about it. That's a July regular month. And just remember that 1870 is 30 and 1920, that's 50 points below the market. 7,100 contracts, big money, is saying, hey, that volatility is implying, no matter what, that these are going to be the kinds of outcomes that mathematically we're totally up there as high as it's going to go. I just wanted to show everybody, though, that there was 9,813. Now, this is 8/16 of calendar 2014 monthly. That was that $1,900 put that you need to know has been marked down, and that 9,800 contracts. Listen, I see more contracts traded across the board where that big money is going to get paid. And once again, just remember that the math will not be able to stay up there. So that's a 1900 there. And we purchased our contracts here at that strike price of 1920. And markets are totally overbought. We had that big bear in play early on, and that bull came in ahead of the Memorial Day weekend, and now we've had a 4-day process tomorrow. We had a light week. So, once again, we're going to see how aggressive these people are. And once again, I'm just going to show you over here on this S&P, they bought 7,500 contracts. That was an open interest. Once again, this is a July one. So there was a lot. And once again, back to that 1870. I mean, this is that put side. And we are at the top of this market on a basis of the math. That is the conclusion. And stay tuned for tomorrow, because there's going to be some big volatility that's coming